I believe. I should probably open that up and just make sure that's happening. Or maybe Corey, you could do that for me. Just pop onto our ONREIA page just to make sure. So lots of spots where you can catch us. So welcome everyone to ONREIA. My name is Jen. This is Shawn Allen, my husband. We are the founders of ONREIA, and I noticed we have a lot of new faces as I was looking at the registration. So typically what we do is just give you a little snapshot of who we are and what ONREIA is all about. So Shawn and I started investing in real estate about 15 years ago. We were both working at an automotive manufacturing company, and we wanted to stop trading our time for money. We wanted to build wealth, and started doing that through real estate. Read Rich Dad, Poor Dad, kind of got bitten by the bug, and we're sort of known for doing flips. We do roughly 30 flips a year. We also have a portfolio of rentals, and now we've started getting into development. So very much, started from not knowing anything, kind of reading the books and watching whatever shows we could, whatever YouTube we could, anyone that was giving out free information, and started getting some real life experience. Eventually we ended up getting a coach, which was fantastic. It really skyrocketed our business. Yep. And about two or 3 years ago.
It's almost 3 now.
3 years ago. We're located just between London and Kitchener. So in our area, there really wasn't any sort of way we could learn about real estate investing. There were some meetups and they were great, but we were looking for something like what the Right Club was doing and what the Durham Club was doing. We wanted to bring investors who were out there, actually investing, actually practicing what they preach, and open to sharing their knowledge with other people. So that's why we created ONREIA, because really we didn't want to drive anymore to Burlington or Durham. We wanted to stay close. So that's what we've been doing for the past 3 years. We invite guest experts to come in and share their knowledge. And it's just a way to give back to the community, a way for us to encourage other investors, and a way to network. That's really our 3 pillars. Connecting people. Real estate is very much a people business, and connecting to others is really important. Now, COVID has made this a little challenging. Normally we would do these meetings in person, but since COVID has happened and we've had to move online, we are now using this webinar. So what I'd like you to do is get active in the chat tonight. We want to encourage you to really try to connect as much as you can with others. So pay attention to who's commenting in the chats. And actually, to get you all started, I'm gonna ask you to do something, a little action item here. If you are brand new to real estate investing, you haven't done any deals yet, you're still kind of in that information gathering stage, put a 1 in the chat. So we're going to identify all the kind of people who are new, and don't worry, like everyone's in their own space here. Yep. We're just reading some of the comments coming in. We would have loved to have run this event in Costa Rica and have everyone join us here, but maybe another time.
Yeah, lots of space here.
Lots of 1s coming in the chat. Perfect. So next, if you are still consider yourself a new investor, so maybe you've done 1 flip or you have 1 or 2 rental properties, but you still feel pretty green, put a 2 in the chat. So we get an idea of who that is. All right. Now, as people are kind of, tons of 2s. As people are commenting here, I would suggest pick a couple names of people that you would like to reach out to, that you would like to connect with, and just jot them down, okay? Not to sound like a, what's the word? A stalker, but you can go on Facebook or Instagram and see if you can connect with these people. Like, this is how we need to network now. We need to get creative now that we can't meet each other in person. So this is sort of how we're hoping you guys can continue to network and build relationships. If you consider yourself an intermediate investor, so you still work your 9 to 5, but you have a few rentals or you've done some flips, put a 3. Put a 3 in the chat. Fantastic. Lots of 3s. Actually, when I was looking to see who registered tonight for ONREIA. I think we have the most level of intermediate investors here tonight. So lots of threes I can imagine coming in. Yep, perfect. And don't worry if, we already passed, you can still put a 1 in if you're brand new, that's totally fine. And then of course, if you are an advanced investor, if you are, a real estate investor full-time, that's your full-time gig, put a 4 in the comments.
Is Corey trying to put a 5 in?
Corey's next level.
Yeah.
Awesome. 57. Perfect. Fantastic. All right. Well, first of all, I want to welcome each and every one of you here. ONREIA really is an inclusive space. We're not for the, totally advanced people. We're not for the brand new. We're for everyone. So I'm really happy to see everyone here, and such a nice mixture of new investors and advanced investors. Tonight, you are going to learn lots of information, so make sure you have a pen and paper handy. You can make some notes. So I'd suggest closing any open tabs you have open on your computer, just so that you can focus, and maybe turn your ringer off or your notifications off, so you can stay really zoned in here, because I think that's going to be a lot of content coming your way. But don't worry if you don't catch everything. We are recording this. We'll be putting it on our YouTube channel. So don't worry about that. Okay, the last piece that I want to mention about ONREIA, because I think it's really important, is we don't want this to be just another webinar that you watch, just some more information that you hear but you don't apply. The really cool thing about this community that we've cultivated is we encourage everyone to take action immediately. This is what is going to move the needle for you and your business and your future. So what I'd like you to do is, as you listen to our speakers this evening, make a note of one thing that you're going to do to take action in the next 2 to 3 weeks. Okay? So make sure you jot that down so you don't forget. What is something that you are going to take action on by, before we meet again next month? All right. And if you're real brave, you can message me and tell me, and I'm going to try and hold you to it, hold you accountable. Okay. So that's a little bit about who we are and what ONREIA is. Looks like awesome. We're halfway there with all the people that had registered. So that's fantastic. So we're going to get started. And before we do, I want to say a big thank you to Corey McKinnon, who's joining us. Corey, why don't you tell people a little bit about who you are?
Everybody, hopefully you can hear me. So I'm obviously, as you know, Corey McKinnon. I live in Sarnia, Ontario. So I'm live in a smaller town. Been investing for about 15, 16 years. And, I actually was doing the opposite of what these guys built ONREIA for, right? I mean, I got busy having kids, building a real estate empire. And I basically got tired. This was before COVID. This is about 3-4 years ago. I was like, I need to get back out there again. I need to be active. And I wasn't pursuing my network and growing my network and my net worth in that way. So it's not that hard what we're doing. It's actually easier now. We're doing this from our living room. So I really encourage people to keep showing up. You're going to learn. I take down notes every single time here too, even though I rate myself a 5 out of 4. I'm here to learn as well. I'm here to meet people. So, and I just want to help to give back. I mean, real estate's, made a huge difference in my life. Being able to retire from the corporate world, just like Shawn and Jen, had the golden handcuffs. It was a really good job, 6-figure job, but it wasn't my dream, right? I wasn't able to go build my own legacy and my thing. So luckily, if it wasn't for real estate, where you could actually leverage your investments and all these other things and make, as much money in a year just by doing some flips and wholesales and really good burrs, I'd probably be still working a corporate job. So I'm here to support you guys and support Jen and Shawn and Jen's event. And because I have that freedom, right? These are all the choices I can make, and hopefully you guys can too in the future. So
awesome.
Yeah,
Thanks
great.
so much,
Corey.
Corey. We appreciate your help and support. One more thing, little piece of housekeeping before we move in and I introduce our first speaker of the evening. You'll see 2 sections down at the bottom of this webinar. One is the chat and one is the Q&A. So if you hear something that you are like really resonates with you and you're like, yeah, great point. Oh my gosh, that was awesome piece of information. put that in the chat. We want to give our speakers that feedback, right? And we want to keep you engaged. So make sure you're staying active. And again, you can see who is chatting here. So make sure you notice, okay, who's talking, who's participating. But the other side is the Q&A. So if any Q&A or if any questions come up that you have, keep them in the Q&A. Otherwise, they're going to get lost in the chat. Okay, so questions, put in the Q&A section. Comments, we'll keep those in the chat.
Yeah,
Sound
we'll
good?
hold the questions until after the speaker is done, and then we'll go through the questions then. So don't get discouraged if you're putting a question in and nobody's answering it right away. We'll hold on to that until the speaker is done, and then we'll go through those questions.
Absolutely. Okay, awesome. So let's get started. I am going to introduce our first speaker. And actually, Corey, I think I need to, did I forget to hand over the host duties to you? How come I can't see anything now? This always happens. Okay, we are going to, there we go. Corey, are you still there?
I am, yes.
Okay. How do I give you the host duties?
Yep, just pull me up, hover over my name, and then there should be an
There you
option
are.
to make me the host.
Perfect. So I'm going to hand that over to you. Okay. And then you can hand that out to the speakers. Perfect. Okay. So I am going to introduce our first speaker of the evening. And excuse me for looking over this way because my other computer, we don't have a printer here in Costa Rica, so I need to use my other computer to read off of. So Hussein Kudrati is joining us tonight. Hussein enjoys working with people to create estate plans that result in their peace of mind. By carefully analyzing their circumstances, he ensures that your goals are accomplished while minimizing unpleasant surprises. And we were talking a little bit about this before the webinar started as to what that could be. You also want to avoid any large tax bills and anything that could come as a surprise that you really don't want at that already stressful time. As a skilled corporate estate and real estate lawyer, Hussein focuses on the big picture and protects his clients' assets upon death. So we're really excited to have Hussein join us tonight. A bit of a heavy topic, but something that doesn't get talked about a lot.
Right.
So we're really excited to have you join us. Thank you so much.
Thanks, everyone, and good evening to everyone attending. And hopefully I can share my screen with you guys. So
Perfect.
let's see if this just works. Does that look okay?
Yep, that looks great.
Okay. So basically, I'm going to give an introduction to estate planning and just helping you be smart upon death. All of you here want to be smart and, invest and make money and move ahead. And now this is how to ensure that stays in the family or how you want it to go going forward. That's just the standard legal disclaimer, lawyers speak, read it later. So your estate comprises of all of your assets. Literally everything you own or you owe is part of your estate. So what is estate planning? It includes planning to support the financial needs of you and your loved ones. It's strategizing to minimize as well as pay the taxes that you will owe. Everyone will owe some tax when you die. If you own a business, as a lot of real estate investors do, it's succession planning. Who will take over? Who will make sure things run the way you wanted them to be running? Identifying a guardian for your minor children. Determining which of your assets should pass via your will and which of your assets should take advantage of other mechanisms to be distributed. Assessing the desirability of various agreements, e.g. marriage contracts, shareholder agreements, JVs. Funeral arrangements. Do you care? Some people are like, I'm gone, I don't care. Some people have very particular wishes. And creating trusts, if appropriate, both inter vivos, which are also known as living trusts, as well as testamentary trusts. Why do people typically avoid estate planning? I'm too young. I cannot afford it. Some people believe they're immortal. Or I'm just plain too busy. The reality is over 50% of Canadians do not have a will. The result is the government benefits and your family is left to manage the consequences. Truthfully, everyone requires an estate plan. Some of the consequences, if you don't plan your estate, and in particular, do not have a will. Your estate, your assets may be frozen. Your principal residence may have to be sold if your spouse is not on title as a joint tenant. The government becomes involved in your personal affairs. If you're in a common law relationship, your spouse may receive nothing. Higher taxes, including an inability to take advantage of a graduated rate estate. And unfortunately, disintegration of a family unit. Effective estate planning will allow you to determine how your estate is structured and managed, distribute your estate according to your wishes, ensure it can be handled efficiently and in a timely manner, minimize both costs and fees upon your death, and reduce income taxes at death. So what are the tools that we can use for estate planning? There's wills, powers of attorney, family trusts, a whole myriad of agreements based on your unique circumstance, and life insurance. With respect to life insurance, lately I'm seeing from my clients, a lot of them come and show me that, hey, we got life insurance. And make sure that whoever is giving you life insurance understands what they're offering and also listens and asks you your circumstances. Because life insurance is a wonderful, powerful tool, but only if used and deployed appropriately and correctly. So I like to say there are 3 taxes on death. There's income tax, which we have to pay every year. There's tax on sale of capital property because you're deemed to have sold all your capital property the day before you died. And then there's the state administration tax, often referred to as EAT. So the state administration tax is payable on 1.5% of the value of your assets. These are the assets that, these can be limited to the assets that will pass under your primary will. These include land, however, a first dealings exemption may be available. And that's something, if anyone thinks it may apply, we can discuss that in more depth. Assets held by a financial institution above a certain threshold that does not have a designated beneficiary assigned. Wherever possible, try and make sure you have designated beneficiaries in place. Assets typically not requiring probate, which is another term for estate administration, include registered assets with a designated beneficiary. Real estate owned outside of Ontario is exempt. Insurance proceeds, as long as it's not payable to the estate, and assets held in an inter vivos trust, also known as a family trust or a living trust. So what is a will? A will provides your instructions for the distribution of assets personally owned by you at the time of your death, a roadmap, if you will. Assets included in your primary will are subject to EAT. Assets in a secondary will are typically not subject to EAT. Remember, when doing your wills, 100% of charitable bequests set out in a will are currently tax deductible from net income. Effectively structuring your will can save a substantial amount of money and can allow you to do some good as your parting contribution in this world. Some will drafting considerations. Is a simple will sufficient, or is a dual
Hello, Hussein. Oh, it looks like we lost our speaker here.
Oh, he's back. He's back.
I'm not sure what happened there, guys. I apologize.
No problem. You're back.
Sorry, I'm just trying to make sure where I was. Okay, so will drafting consideration. So simple
You're,
will or dual
sorry
will?
to interrupt you, Hussein. We need you to share your screen again.
Let's do this again.
Perfect.
So, so basically some considerations for will drafting. Is a simple will right for you, or is a dual will the right option? It's not just for business owners. Please make sure you have a discussion with your advisor about whether a dual will is right for you. Also, make sure you make a full inventory of your assets and special requests. What do you want your will to include? Who do you want to leave things to? Make this an ongoing task. Before you even get your lawyer, know how you want your assets to be distributed. And alternate beneficiaries. Consider a common disaster clause. What if something happens to you and your immediate family at the same time? What should happen to your estate? You've worked hard to accumulate the assets. Make sure they're being distributed appropriately. Who will be the guardian if you have minor children? And what I would say is most important is who is the executor and what powers are you going to empower them with? And then funeral instructions.
Hussein, could you go back one slide, just the one before?
Sure.
I don't know. I think someone wanted to see this one more time.
Sure. I can also share the slide for you to give to the group if you wish.
Oh, that'd be great. Awesome.
Yeah. So what is a secondary will? So a little bit of history in Ontario, when the government brought in the estate administration tax, some creative lawyers decided that, you know what, we'll just create two wills. The assets that have to go through the primary will, which are typically registered assets of some sort, we'll put in the primary will, and we'll create a secondary will that essentially will deal with everything else. Courts have ruled on it and upheld this form of estate planning. There were some recent challenges that were unsuccessful by the government, and therefore the secondary will still stands as a legitimate estate planning tool. Essentially, it's used to distribute assets that do not require certificate of appointment of a estate trustee. A skilled estate planning lawyer will try and put as many assets of yours into your secondary will to minimize the EAT. And but one of the things, and this goes to the powers that you're going to give to executor that we'll talk about later, is the ability to disclaim assets from your secondary will. And
I see that it's frozen from my end. And yes, you guys can see me too.
Okay, so sorry guys, we'll have Hussein pop back in, and maybe we'll have him turn off his video. Maybe that's eating up too much bandwidth or something. Here I am talking like I think I know what I'm talking about.
Maybe
Okay.
I can help answer Mean Fan's question.
Perfect.
So she asked in the Q&A what sort of assets go into secondary will. And Hosting is here, so I don't have to pretend I know.
Perfect. So Hussein, I think maybe if you try turning off your video, perhaps it will help with the presentation and keep you from freezing.
let's try this. I disabled participant screen sharing.
Oh, are you not able to share anymore?
It just says host disabled participant screen sharing.
Oh, Corey, can you get that set back up? Did someone say there's a storm going on in Ontario right now?
Yeah, we just had a power outage. That's why you guys lost me.
Oh, okay. Windstorm. See, if everyone was in Costa Rica.
That was much more dependable power here in Costa Rica.
Yeah, super dependable.
Do the code again. You may want to try to tether with your phone or something that might be a little more reliable. Just an idea.
Okay.
All right. Thanks for your patience, everyone.
Yeah, apologize, everyone.
Oh, no worries.
So, considerations for dual wills. Am I still there?
Yes, yes.
Okay, just want to make sure, because considerations for dual wills. Real estate should generally be included in a primary will and is subject to E. The exception is if you have a first dealings exemption, which is essentially if you've owned property before 1995, or sometimes if you've inherited property, you can take advantage of the transition exception when land is converted from land registry to land titles. Shares in a privately held Canadian corporation and personal belongings can be transferred via secondary will in most cases. From an estate planning perspective, and I know Cherry's going to talk about the benefits of incorporating as a real estate investor, this is one benefit of potentially holding real estate in a corporation. Ensure effective clauses are drafted to reduce the administration of both of your wills. So for example, if you have testamentary trust provisions for your children, include clauses that allow for consolidation of trusts or for the disclaiming of assets. And disclaiming of assets is really important in your secondary will, because if there is for some reason an asset that was included as because you're trying to be aggressive at minimizing E, your whole secondary will would then be subject to being part of a state administration tax. But if your executor can disclaim an asset from your secondary will and put it back into your primary will, the rest of your secondary will can survive. So what is an executor? This is the person responsible for carrying out your wishes as expressed in your will, including but not limited to funeral arrangements, filing tax returns, inventory of assets, establishing trusts, and distributing your assets. Important executor rights: the right to manage digital assets. Some of you may have invested in cryptocurrencies. A lot of you have online banking or social media profiles. People don't really think of this as being part of their assets, but a lot of them do. Like, I mean, if you think about someone like Kylie Jenner, right? Each post she makes earns $1 million. So her online profile could live forever in theory. Obtain executor liability insurance and include a provision that your estate will pay. It's a lot of responsibility and a lot of risk to be an executor. So to make sure that your executor is willing to take on that responsibility, allow this as a comfort. Include the right that they can take out or renew mortgages, so that if a mortgage comes due, it doesn't necessarily force an unfavorable timing sale of your real estate. And again, consolidate trusts wherever possible. Guardianship. Your will should identify who you wish to gain custody of your minor children. However, the appointment by your will is only valid for 3 months, after which the person you appoint must apply to a court of competent jurisdiction to be permanently appointed. Please make sure that you include a clause to allow your estate to pay the costs incurred. Currently, the estimate that I'm seeing is it's about $15,000 to $20,000 to complete a guardianship application, which is a lot of money for a lot of people. A guardian is not automatically guardian of property, and this is what I was talking to Jen about earlier. This needs to be specifically provided for. If it is not, and your will does not contain explicit testamentary trust provisions, property left to minor children is payable into court. And that would mean involving the office of the children's lawyer every time you want distributions, and there's significant cost, delay, and complexity associated with that. Make sure you have a conversation with your guardian and they understand their responsibilities and they do so willingly. Trusts. Trusts are used to achieve both tax and non-tax objectives. It allows for continued control of your assets, reduce the amount subject to probate, estate administration. It is not subject to deemed disposition upon your death. Can be useful for multiplying the lifetime capital gains exemption, but that doesn't necessarily apply to real estate unless you have a skilled accountant like Cherry helping you. Trust assets do not become part of the public record, so you can retain privacy. However, they are subject to the 21-year deemed disposition rule, which essentially means that every 21 years, your trust will have to pay tax on the capital that it holds. The pitfall, beware of income attribution rules. And again, if anyone is seriously considering trust, that can be a separate presentation itself just on attribution. So what are the key roles in a trust? There's a settlor, the person who creates the trust by transferring property to the trustees. This could just be a coin, it could be a $20 bill. It doesn't include all the capital you put in. Other people can put it in. The settlor is just the person creating the trust. The trustee holds the property for the benefit of the beneficiaries. The trust is considered in a lot of aspects as a separate entity. They can own property in their own right, in their own name. And the beneficiaries are the people entitled to receive the assets of the property of the trust, either income or capital. The success of a trust will be determined by the ability of the trustee. Inter vivos trusts, also known as family trusts, some of the advantages: the terms of the trust may allow for distribution to your children or spouse beneficiaries, can be structured to have income earned taxable to the lower income children. Even with the changes to TOSI, it is doable. Structure may offer creditor protection benefits for the family, and EAT may be avoided. The disadvantages: depending on trust structure, you may no longer have access to the assets for personal use. And this is where the attribution rules may apply, because if you've contributed money or assets to the trust, you cannot take it back. Costs associated with administration of the trust. Testamentary trust, potential advantages are you may offer a level of control over the timing of distribution. If you have young children, or you just feel that your children may not have the maturity to inherit a large sum right away, you can stagger how they receive their money. May provide an effective solution for concerns around spendthrift beneficiaries or disabled beneficiaries. Disadvantages, again, are costs and probate fees for assets funding the trust if it's subject to the primary will. Additional trust options: if you're a blended family, a spousal trust may be appropriate for you, where you leave money, income, and capital for the benefit of the spouse for their lifetime, and then it can be paid to your children. And if you own US property, you may want to consider cross-border trust as an effective tool to manage, and it's something that I personally have availed myself of as well. Some proactive management tips you can make for your estate before your death. You can make gifts during your lifetime. You can make beneficiary designations. If you're a business owner, as part of your succession planning, you can take advantage of tax-deferred rollovers and estate freezes. You can have joint title to assets and take advantage of just bare trust declarations for your lifetime. It is important, however, when you're proactively managing, is that you retain control of sufficient assets to provide you with the quality of life you desire. Some thoughts for real estate investors. Real estate can be transferred to a spouse using a spousal rollover and be put into a spousal trust. Except for a principal residence, real estate requires your estate to have liquidity, so make sure you're thinking about how those capital gains taxes are going to be dealt with to prevent a forced sale of property. When buying property, give thoughtful consideration to what entity should be the beneficial owner of the property. Always remember that there can be a legal owner and a beneficial owner. They don't have to be the same. And make sure if you're giving real estate to any of your beneficiaries, they understand not to use inherited property as a matrimonial home, because as soon as you use it as a matrimonial home without certain agreements in place, it loses the characterization of inherited property. estate planning is also an ongoing process. It's not a one and done thing. It's a constantly evolving, living, breathing organism. Review your estate plan on a consistent basis and advise key holders of any changes. Some of these are marriage or divorce, children or grandchildren, disability, purchase or sale of a business, asset growth, assets in different jurisdictions. And that's the end.
Fantastic. Awesome. Let's see here. Where are you? There. Wonderful, guys. I don't know if your mind was blown on some of those points, but I had no idea about some of those. Fantastic, everyone in the chat here. So questions, we're going to head over to the Q&A. And if you guys have any questions, make sure you post them over there. We're seeing lots of great feedback here. Hussein, excellent info, great informative presentation. Let's get to some of the questions. So here's one from Min. What sort of assets go into a secondary will? What would some examples be?
Shares in a privately held Canadian corporation, jewelry, personal belongings, any kind of collections, artwork. You can even put in vehicles. So essentially, it's easier to say what goes in a primary will. Anything that has a government registration or anything above $50,000 held with a chartered bank would have to go in a primary will. So that's generally the metric. So if there's a registration like land titles, has to go through a primary will, but even then there are exceptions. So it's important to go in and make sure that you're giving the right information. Because if your professional advisor is not asking you questions and is giving you a generic response saying, oh, well, this is it, just fill out the questionnaire. Because the questionnaire is a great starting point, don't get me wrong, but they have to take the time to actually understand what you own and how you want to, see it grow. Because a will shouldn't just be about what you have now, but where do you see it going in the future as well? There should be some planning involved in that.
Great points. Can you turn your video back on?
Sure.
There, now that the presentation's over, I think we're safe. Okay, so here's from Gabriel. What is the estimated cost of a typical will with assets under 1 million?
So it depends on whether a secondary will would be appropriate for you or not. If you just need a simple will for one person, it should be about $500 plus tax. If it's for a couple, like a husband and wife, then you look at about $800 for simple wills. Dual wills, you're looking at, that's typically an hourly rate engagement because there has to be a lot of thought as to how you're structuring that. So that's whatever the hourly rate of the professional is.
Awesome. Dominique is asking, what is the connection between setting up a trust, for example, family trust, inter vivo trust, and assigning a trustee on your life insurance for your kids? Is one a legal structure and the other not?
So one is just someone acting as a trustee. So a lot of times when you have life insurance policies with minor children, you'd appoint someone to just act on as a trustee for them. That is just acting in a very specific, narrow capacity. A family trust is actually kind of like a corporation where you're creating a separate entity, you're transferring assets to them. You're no longer the owner of those assets, right? Like, well, for the life insurance policy, while you're alive, you still own that policy. You can borrow against it or whatever you need to do with respect to that. So that's the difference. Family trust is actually a specific document that you create that essentially you'll open a bank account in their name. You can do anything in that name.
Interesting.
I have a question. If you, so let's say for an advanced investor or someone who's doing a lot of deals, for example, let's say you're doing, a couple dozen deals, buying and selling a property a year.
Mm-hmm.
If you do a will,
Mm-hmm.
how often are you supposed to be updating this, and are you doing it over again? Are you just adding to it? Is there amendments? How do you react to that stuff?
So the way I draft my wills is because I have clients who do multiple transactions a year. You can structure it so that they don't have to keep coming back because no one's going to want to keep paying legal fees every multiple times a year as these transactions done. So what I would say is in your circumstance, like, when you said you transitioned from being flippers to having a rental portfolio, when there was a slight change there would be a conversation about how you're structuring each aspect of your real estate sort of business overall. And then when you go into land development, I'd say that would trigger again a review of how we're structuring your will for that. Because again, when you take steps like land development has a little bit more risk, is a little bit more, delayed gratification, if you will. It's a lot of initial expense that you're putting into it. So again, it's about how are you going to structure that to, minimize your risk, make sure your children's future is not being, mortgaged, for lack of a better word, and making an estate plan that compensates for that.
Okay.
So it's about more what are you doing as opposed to the quantity. The quantity should not change your will.
Cool.
Great.
Pri is asking, what would you recommend for estate planning with real estate assets purchased under a corporation by JV partners, like non-family members?
A lot of that I would say that make sure you get your JV agreement reviewed by the lawyer making your will. If you've had a will where your JV agreements were not reviewed, I would suggest that you need to go back and revisit that.
Cool. Okay, after purchasing my house, this is Gabriel. After purchasing my house, my law clerk who helped with my legal real estate paperwork told me that I have so little assets, it's not worthwhile for me to get a will. Is this true? And if so, when should I get a will?
Think about it this way. If you die intestate, right? One, you don't have control over who's going to be responsible for administering your assets. Two, if you have children, do you want to make sure that they can get access to your resources, upon your death? They've already lost their parent. So that's a second consideration. Three, do you want to just automatically pay 1.5% estate administration tax? And as I said in the beginning, everybody should have a will. Like it's a fairly small expense in the overall scheme of things, because if you die without a will, your estate is going to pay far more. You might think that you're saving, a few $100s during your lifetime, but in the end, you're still paying for it from your final taxes. So it's going to come out one way or another.
Right. Okay. Good point. Betty's saying, great presentation. Thank you. How much is it common to pay an executor? And can you have a lawyer, for example, to be the executor if you don't want to burden your family?
Sorry, you just broke out. So what was the second part of the question?
So first part is how much is common to pay an executor?
Okay.
And can you have a lawyer, for example, be the executor if you don't want to burden your family?
Okay, so the first part, what's common is that you can negotiate with whoever you appoint as executor and put it in your will to say that they'll be paid X. You can just make them a gift and that's all they get, So you can say, for example, I leave Betty $5,000 for acting as the executor, and she only receives it upon her successfully completing my estate. That's one way. Otherwise, you can put just a reasonable compensation clause, and the applicable Estates Act legislation currently says 2.5% in, 2.5% out. So that they can get up to 5% of the value of your estate. That is likely going to change to 6%. But that doesn't mean they automatically get 6% of the value of your estate. They still have to show receipts and proof that they actually did the work to justify it. The second part is the lawyer who drafted your will cannot be the executor because it's a position of conflict. So it'd have to be a different lawyer. If you do get a lawyer who agrees to do it, unless they're a close personal friend, you're very lucky, because honestly, being an executor is a lot of work. Like the joke in my office is it's marriage without love.
All right. Jorge is asking, so what happens if you don't have a will and you have say a portfolio of rental properties maybe?
Essentially, once the bank knows you're dead, a lot of mortgages include a clause that just says that, if you're deceased, your mortgage is due, right? So now you don't have someone who's going to be dealing with it. So the bank will probably ask the court to appoint someone to act in that capacity, unless a family member says, I'll step up, I will do it. But then they have to apply to be made, appointed as administrator of an estate without a will. That's a bit of a lengthier process, a little bit more costly, and you don't get the protections. Like, for example, like you can't use the estate now, or whichever family member steps up to pay for the cost. It's all coming out of your pocket. How many of them are going to want to do it? And there's tariffs. If the court appoints someone, they get paid a lot of money. Like you're looking at minimum about 20K starting, for someone to pay that role. And it usually goes a lot higher. So it's very unpleasant.
Very unpleasant, I would say so. It sounds that way. Elena is asking, can the spousal trust be explained in a little more detail?
Sure. So a spousal trust is when you can do it whenever you want, but there's such strict rules to how a spousal trust should be enforced that I typically discourage it unless there's a blended family where there are biological children on one side. And the benefit of it is you can make sure that your spouse is taken care of for the rest of his or her life by saying that whatever I have, I give to them, whatever income is earned on those assets, it's for them to have. And then when they die, they don't get to bequest that though, because it's still technically mine and it's in trust. Whatever's left over goes to my children. Now, there might not be anything left over because the spouse might decide, they want to travel first class to Fiji 3 times a year. So, but that might happen. But at the end of the day, the spousal trust ensures that once your spouse dies, that money goes back to your children. That's the purpose of a spousal trust.
Awesome. All right, we'll take a couple more here, and then maybe Hussein, anyone, it looks like we still have about 14 more questions. They keep rolling in. So we'll answer a couple more live here, and then perhaps when we move over to Cherry's presentation, could you type in the answers in the Q&A instead?
Sure.
That's perfect. Okay. So this one is an anonymous question. How can bear trusts be used in owning residential properties? Like, are there specific tax benefits or legal benefits, and how much does it cost?
So this is where if you want to put assets into a corporation, but as I'm sure a lot of you in this presentation know, banks don't particularly want to lend to corporations, especially when there isn't a lot of history there. So what a lot of people do is they take a mortgage, like they close on a property in their personal name, and then they go and they create what is known as a bare trust declaration, where they say that we only went on title because the bank to get a mortgage from the bank, but the intent is that this money belongs, the corporations funded all the money in reality, and the corporation is a beneficial owner. The corporation is going to file any rental money or whatever we earn on the property. Corporation will own the losses, and that's what the bare trust agreement does, and it essentially ensures that for all legal purposes other than ownership on paper for the bank's benefit gets aligned with the corporation. So that's the benefit of using a bare trust declaration. And it's extremely common for real estate investors to use that. And often even you'll find that bare trust declaration agreements and JV agreements get combined into one document.
Okay. Mary's asking, with regards to being proactive, what does it mean for joint title to assets? Does it mean that we can make our child as joint owner of a real estate property, for example?
That's exactly what it means. But again, make sure that you're retaining sufficient control and you're determining if it's wise and prudent to be making them joint and how you're making them joint. Because there's some challenge to the concept of a resulting trust, but there is some movement that if you add an adult child on title to a property and it's deemed that you just did it to avoid a state administration tax, there is now case law that they are disallowing that. So it has to be done strategically and in a way that it's not blatantly obvious what you're trying to accomplish.
Okay, we'll take one more here. And then for everyone who's asked a question, Hussein's going to type in the answer. If you have more questions, I'm going to be sending out an email tomorrow with everyone's info. So you can reach out to Hussein. He'll give me his contact info and you can connect with him. What's the best way to reach you? Through
email or phone, whichever. I'm pretty accessible.
Awesome. Okay, we'll do one more question here. Candace is asking, is a secondary will notarized in the same manner as a primary will?
So neither will is actually notarized in the province of Ontario. A will has to have 2 independent witnesses, and not just as a signing page, but the witnesses along with the signatory must initial every page of the will and then sign the last page of the will, the primary will and the secondary will, the requirements for signing are exactly the same. And they have to be done on the same time, on the same day.
Okay. Well, thank you so much, Hussein, for all of this fantastic info. Very complicated stuff.
Yeah.
Lots of layers to this. That it's important that investors have someone like yourself to help them through this process. Excellent. If you guys have more questions, make sure you put them in the Q&A section of the chat, and he will get to those. He will type those in. Everyone give a big round of applause. Thank you. Thank you.
Thanks, guys.
All right. Fantastic. So next we have, so I'm going to just take a pause for a second and ask that if you are finding value in this evening's presentation, that you go to our Facebook page, and I'll give you, you're allowed to open up one tab on your computer right now. Go to our Facebook page, the Ontario Real Estate Investors Association, and give that page a like. Even if you felt like it, rate us like 5 stars, do something nice, because we are trying to keep continuing to support investors, both new and advanced. So the more people get on our page and hear about who we are, the more we can help support you in realizing your real estate dreams. That sounded really cheesy, but you know what I mean. Okay, so we are going to move on to our next guest speaker. And again, excuse me for looking this way while I pull up her bio. So Cherry Chan. Now, I think a lot of you have probably heard of Cherry. She is quite active, posting blogs. I know we've posted a lot of Cherry's blogs to our ONREIA community page, but I'm going to give you a rundown of who Cherry is. Cherry is an entrepreneur, an author, a blogger, and a mom. Her accounting practice specializes in helping real estate investors reach their investment goals. Now, Cherry started investing in real estate about 10 years ago. She started with a student rental and started adding a couple more in that same year. And now she owns multiple properties with her husband, who you might know, Erwin Zito. Cherry graduated with the honor roll on the Chartered Accountant Uniform final exam and top 10 in Ontario, top 50 in Canada, and was named top 50 women in accounting globally in 2018. Pretty impressive. She's worked with hundreds of real estate investors, and through her blog has been inspiring others to take charge of their lives and make change and take action. She is a best-selling author on Amazon for her book called The Complete Taxation Guide to Canadian Real Estate Investing. And Cherry is going to be talking to us tonight about whether or not you should incorporate and all of the tax goodies that you want to know about. So get ready, get your pen and paper out, and we are going to get started. Welcome, Cherry.
Thank you. Thank you. Thank you so much for having me. I'm a bit scared now after that introduction. So I'm just going to try my best. Let me see how I can do this right. This is good. I am just going to share my screen, if that's okay. Let me see, screen 1, yes. You can see, oops, 1 second. Okay, so you guys can see it clearly?
Yep, we can see
Okay.
you and your screen.
Okay. Awesome. Thank you. Thank you so much for having me tonight. Thank you so much for joining me. I hope it's not going to be a boring presentation. I have created this presentation so that everyone will get something out of this presentation, whether you are a brand new beginner or whether you are a more experienced real estate investor. Hopefully you will get something out of this presentation. Here is a little bit about me other than just an investor and what I achieve in my professional life. I do a little bit of CrossFit in my early days. Nowadays, I don't do nearly as much. I'm married to this guy. He called himself Mr. Chen. He actually nicknamed himself Mr. Hamilton, but he recently called himself Mr. Chen. We together have build this family, and these kids are now 7 and 5. Can't believe how fast they grow. Together with a bunch of friends, we co-found this small charity called Hamilton Basket Brigade. We provide the much needed necessities to people who are in need in Hamilton, mostly in city of Hamilton. The upcoming Easter, we are donating $20,000 to buy daily necessities to these people. I have this blog. For those of you who are not on my blog post yet, make sure you sign up. I do a weekly blog post on tax tips, and hopefully you can find it interesting as well, useful. I am also a chartered accountant. Like I said, I own my own accounting business, and I work with over 200 real estate investors to help them structure their real estate portfolio, as well as to provide ideas to help them lower their taxes. And I wrote this book a couple years ago, in 2017. And if you want to follow me, it's these are the Instagram and social media link. Make sure that you follow me. Sometimes I share something that's interesting. A special gift tonight for everyone who wants to find out more about how to turn your primary residence mortgage to a tax-deductible mortgage. You can go to realestatetextips.ca/ONREIA. And you would then be able to get access to this video that I did for my clients only. We talk about how to implement the Smith maneuver as well as cash damming strategy. So this could be something that, if that's something that you are interested in, make sure you head over to realestatetextips.ca/ONREIA to get on. It's ONREIA, right? ONREIA to sign up. Now, a little bit of a disclaimer, just like Hussein, I'm not responsible for anything I say here, so good luck with it. Well, the truth is, I am presenting information for general purpose only. Don't take this and then go implement it on your own. Sometimes it's applicable to you. Sometimes it may not be applicable in your particular situation. So make sure you consult with someone that actually knows your situation before proceeding. Now, tonight's outline, I'm trying to cut it down, and I promise you I will finish within 1 hour. And I will get out by 9 p.m. But today I'm going to go through some basic taxation 101 concept, the top 12 deductions that you should not miss as a real estate investor, because I know some of you are brand new. So I want to throw that in so you guys get a better understanding. And it's also tax season, so it's important for people to understand. And then at the end, I'm going to wrap it up with everything you need to know about incorporation. Okay, I'm going to speak really fast, I think, because this is a lot of material. So, okay, so let's get started. Basic ownership in Canada, there are 2 types. You either own something in your personal name or in the corporation's name. You can own something even if you partner up with someone else to own something, to own your property, rental property, or investment property. It's either you personally reporting the income, or that person personally reporting the income. If your corporation own the property, you own your you own the shares of the corporation, and the corporation owns an interest in the property. Your corporation will be the one that's reporting the income. Even if you form a partnership, with another person, or you buy a limited partnership unit interest, that if you buy them individually in your personal name, they will have to be reported. The income or losses would have to be reported in your own personal name. If you buy it in the corporation's name, the income and expenses would have to be reported in the corporation name. So this is the reason why tonight we're only going to focus on individual taxes and corporation taxes. Now, our Ontario tax or Canadian income tax system it's called, the personal side, it's called a progressive tax system. What it means is that the more you earn, the more you get taxed. Now, in front of you is a presentation, a slide that I got from taxtips.ca. It's not my website. I wish it is my website. but it's a very useful website that you can get your latest marginal tax rate on. What this chart presenting is that the different tax rate that's applicable to different marginal tax bracket. So using 2020 as an example, basically from $0 to $13,000, you don't pay any tax. It's not even on this chart. You don't pay tax because that's called personal tax exemption. Between $13,000 and the $45,000 that you see on screen right here, you're paying 20% tax. The way you calculate the tax payable is that you take $45,000 minus the $13,000 personal tax exemption. The delta of $31,000 is taxed at 20%. And then between 45,000 and 48,000, the delta 48 minus 45, that $3,000 delta is taxed at 24%, and so on and so forth. If for someone who's earning $150,000, we have to go through the calculation of every single tax bracket, calculate the delta of it, and multiply by the corresponding marginal tax rate to come up with the total tax payable. So this also means that if you are making $150,000, we have to go all the way up to the $150,000 tax bracket. The highest amount of tax rate that you would have to pay is 43%. And this 43% is being applicable to the last $53,000 of your income. So you can see that you earn $53,000 and you pay $23,000 to CLA. You're only keeping $30,000. Now, this also means that for someone that makes $150,000, if they were to earn an additional $10,000 income, that additional $10,000 income, we can just ignore the 150,000, this 45% tax bracket, because it's only $473. The whole $10,000 taxable income that you get, additional income that you get, it's going to be subject to 48% tax. If you make over $220,000, any income above and beyond that $220,000 is subject to 54% tax. So in another word, CLA gets to keep more than you do. If you already make $220,000, you earn an additional $10,000, CLA will keep 54% and you get to keep 46%. That really sucks. Now, the corporation tax is very different. Corporation tax is for any active business income that you earn within the corporation tax for a small business, qualified small business. The first $500,000 is taxed at 12.2%. Now, but corporation tax is different when it comes down to passive income. Passive income, also known as specified investment business income, includes rental income, dividend income, interest income, as well as taxable portion of the capital gain. It's first taxed at 50%, 50%, and then 30% would be refundable with the taxable when you declare a taxable dividend. The net tax payable is 20% inside the corporation after you declare a taxable dividend to the shareholder. When you declare a taxable dividend to the shareholder, which means that what it means is that the shareholder themselves would have to report that as their income in their personal name and get taxed. You don't get double taxation because our system is designed with the tax integration in mind. The total corporation tax that you pay in the corporation plus the personal tax on the dividend that you receive would equal more or less the same amount as if you were to own properties directly in your personal name. There is no tax benefit, but there is, if you assuming you take all the income out in the same year. But if you don't do that, or if you declare a taxable dividend to someone that's low income family member that doesn't make nearly as much as you, that could be something that you can take into consideration and help you save tax from that angle. So we play around with the share ownership in terms of corporation, as well as people, as well as the different tax rate within the corporation to make sure that you pay the least amount of taxes. Now, for someone who, there is always that question. People always get confused as to how you can convert the 50% tax to 12.2%. If your business require more than 5 full-time employees and hire more than 5 full-time employees, you can then pay as little as 12.2%. But your rental business has to be big enough to afford to hire more than 5 full-time employees. Majority of my clients do not qualify. And I have a couple of clients that own a couple of big 100-unit building, and they still do not need to hire more than 5 full-time employees. So it's very unlikely, unless you are planning to grow to a sizable, extremely large portfolio, it's unlikely that you would be paying 12.2% tax. Now, another important concept that I want to go through is income versus capital gain. Now, this is very important because this is the reason why we're investing in real estate. One of the many reasons. If you earn $100,000 employment income, the entire $100,000 is taxable. You see the calculation that I showed earlier. The $150,000, if you earn $150,000 in your personal name, you pay $45,000 tax. But if you using that same $150,000 as an example, if it's earned in the form of capital gain, only 50% of the $150,000 would be taxable. So only $75,000 would be subject to tax. The other $75,000 would not be subject to tax. So $75,000, if I take that $75,000 and go through the same calculation as we had done before, we may pay very little tax. That's $9,000 plus $6,000. That's about $15,000, $16,000 of tax here, versus you would have to pay $45,000 if you were to earn income. Now, when you buy, what is considered income, what's considered capital gain? It's determined based on a set of criteria set out in the court. And here are all the criteria that they look at. Are you doing this transaction in the normal course of business? How often do you do deals? Is there advertising effort involved in doing these deals? Are there improvements made, such as renovation? Do you have insider knowledge? If you are a real estate investor, if you publicly acknowledge that you are a real estate investor or you're an expert, they may consider you as an expert. They may take that as the evidence to prove that you are doing the purchase and sale of the property as income, as a business, rather than capital gain on a capital transaction. And they may tax you on the income account rather than the capital account. If they tax you on the income account, 100% of the profit that you make from the deal would be taxable. And if they treat the transaction as capital account, only 50% of the profit would be taxable. Would it be possible for you to generate another source of income other than selling it? What is your intention? Do you have a trading motivation? If you plan to flip it, as soon as you mentioned you plan to flip it, flipping automatically is considered on income account. 100% of the profit that you make from selling the property would be considered income. 100% of the assignment fees, someone was asking earlier, directly asking, what is the tax treatment on assignment? Well, assignment, if you do it intentionally, majority of the time they're considered on income account, meaning 100% of it is taxable, and the assignment fees alone would be subject to HST. So just because the pre-construction condo has appreciated a ton, when you sell it on assignment before closing, it does not mean that you necessarily net the same $100,000 profit that you thought you would net, because that $100,000 that you think you would net, you have to pay CLA, the HST on the sale. You also have to account for it on income account, meaning 100% of whatever that's remaining is taxable. So a large CLA may collect a large chunk from you as well. So be careful when you're doing pre-construction condo assignment deal. Rent to own can be considered income at times, especially if you are doing rent to own as a business. If you're building new houses and selling it immediately, those are also considered income account. Now note that because these are considered income, the top 4 here, you see, if you sell it in the corporation and they are considered 100% income, they are considered active business income and they are being taxed at 12.2%. So it's very beneficial to own these, do these property deals inside a corporation because you can take advantage of the low tax rate inside the corporation. Now, rental income is also considered income. 100% is taxable, but because in the Income Tax Act they specifically call out rental income as specified investment business income, and therefore the specified investment business income is taxed differently at the 50% with 30% refundable, and then at the end you pay 20%. Now, property management fees is active business income as well, so it's subject to 12.2% tax. Now, what's considered capital gain? Capital gain, pretty much almost all long-term buy and hold are considered capital gain. Whether it is long-term buy and hold on long-term buy and hold with your commercial properties, long-term buy and hold on your industrial properties, long-term buy and hold with multi-unit residentials, long-term buy and hold student rental, legal duplex, legal triplex, they are all considered capital gain when you sell. So these are the common examples, and you have to be careful. Only there are people who thought that if they move into a property, they can automatically and move out immediately. They could automatically sell the property without paying tax because they could take advantage of the primary residence exemption. If you have a trading motivation, looking at all these criteria in the previous page, if you have a trading motivation, even if you live in the property, CRA may still consider you to be on the income account, the sale of your so-called primary residence residence. So they may disallow your primary residence exemption. So really be careful with these criteria and make sure that you're understanding income versus capital gain and account for it accordingly. And we are going to come back on the corporate structure based on what we just learned here a little bit later. Now, let's just focus on the top 12 tax deductions for rental properties in the next little while. Because we are in the tax season, in the heart of tax season, I figure a lot of you would be interested in learning what are the top 12 deductions. Before I go into any of these top 12 deductions, the number one thing that I did not put it on slide is make sure that you keep all the proper documentation. The reason why I say this is because in Canada, there, I'm pretty sure in the Western world, you have to earn your tax deduction, which means that you actually have to provide proof that you spend the money, and which also means that you need to keep the records, including the invoices. Just so you know, Visa card statement, bank record does not count as proof of expense. You actually need to provide the actual documentation, meaning the invoice, as well as the rental agreement. Those are what count, like those documents are what CRA would look at and consider as the proof of expense and proof of income. So make sure that you have those legal documentation. And that's number one rule. The number two rule is that in Canada, when you own any rental properties or when you own a business, you are pretty much eligible to deduct any expenses, all expenses that you incur for the purpose, all reasonable expenses that you incur for the purpose of earning the particular income, subject to a bunch of exceptions. So what it really means to all of you is that if you are able to establish the link of incurring the expense and earning the business income, you would then keep the receipt. That's what I would do. Now, not every accountants are generally busy. If you work with an accountant, you may not be able to ask your accountants immediately whether this receipt particular expense is deductible, but by all means, keep your documentation, keep the receipt. Receipt is the bare minimum that you will get the tax deduction. If you don't have the receipt, you won't get any deduction. So by all means, keep the deduction, keep the receipt and accumulate a bunch that you're unsure of, and then talk to your accountant at the end of the year and see if you would be eligible to deduct the expense. Now, here is the top 12 deductions for rental properties. Number one thing is finance charge. Earlier on, when I first started out practicing in the real estate accounting industry, a lot of people were using 5% down to purchase rental properties. And back then it was totally allowed. And if you use 5% down to purchase rental properties, you would have incurred this CMHC insurance. So you would have to be forced to buy this mortgage insurance, whether it is CMHC, Genworth, or any other, I don't remember the third insurance company name. There are only 3. And that amount would be tax deductible over 5 years, even though you don't actually pay it out the year that you purchase the property. Typically, these mortgage insurance is being added to your mortgage, and you pay for it over a number of years, over the term of your mortgage period. But this particular expense is deductible over 5 years. So you can actually take the amount out of your financing, out of your closing document, and deduct it over the 5-year period. For those of you who invest in a multi-residential unit, and if you buy CMHC insurance, I know that they insure over, if you are not 85%, 80% loan to value, you are not doing you're doing over 80% loan to value, you will again be required to buy CMHC insurance. And then if you do buy CMHC insurance, again, that's considered finance charge. It can be deductible over 5 years. Now, common example of finance charge is if you borrow, if you get your financing through a mortgage broker, and they sometimes charge a fee for arranging the mortgage for you, especially if you're working with B lenders such as Home Trust, they would charge a fee, and that fee would be, again, tax deductible over 5 years. You may not pay for it at closing. You may or may not pay for it at closing. That would be tax deductible. For those of you who also use private mortgages to finance your flips, that would also be considered an expense that could be, hopefully, you don't have to wait for 5 years. You could still deduct it against the sale of the property immediately. But if you happen to own these properties for a number of years, you can write it off over 5 years. Now, line of credit interest, number 2, line of credit interest. The reason why I wanted to mention line of credit interest is that people doesn't seem to understand that interest is tax deductible if the fund borrowed is used for investment purpose. So essentially, if you borrow against your home equity line of credit to purchase a rental property, that is, the line of credit interest would be tax deductible. If you refinance your own home, your primary residence, and get a bigger mortgage, so original mortgage could be 600, and after you refinance it, the new mortgage become $1 million. That additional $400,000, if you use it for the purpose of investment, the interest on that $400,000 would be tax deductible. Now, I mentioned earlier, documentation really matters, especially when it comes down to line of credit interest deduction. The reason I say this is because when it comes, you have to prove the use of funds. When you refinance, using the example that I just shared, the $400,000 that you pull out from your home equity, it has to be deposited in an account for investment purpose. Even if you have no immediate deal, your rental property doesn't close until a month later, you have to deposit that $400,000 directly into a saving account that only earn interest, doesn't do any personal expense at all. You put it in, at least you're earning interest. It's for investment purpose. I know the interest is nothing, but at least it's for investment purpose, and that account is used for investment purpose. That would allow you to continue to deduct the $400,000. That provides the proof that you are incurring the interest on the $400,000 as for the purpose of earning additional income. So that $400,000, when you put it into the rental property, the interest expense would continue to be able to, you can continue to deduct that interest expense on the $400,000. Now, and the second thing that I want to mention about the line of credit is that if you have a line of credit available, let's say $200,000, if you have a line of credit available, that $200,000 line of credit, if you don't separate the line of credit into a personal use versus the business use. When you mix the personal use with the business use, it may forever taint your interest deductibility. Let me just explain using an example. Let's say you have a $200,000 line of credit and you use 180,000, 90% for investment purpose, and then you use the other $20,000 for personal use, maybe a trip to Whistler, because this is the only place that we can go to right now, or maybe go to Costa Rica for 2 months. And now these are personal expenses. Maybe that's not the case, but let's say these are personal expenses. It's a personal trip. That 20,000 interest on that $20,000 is not deductible, which you would be fine. So 90% of the interest on the line of credit would be deductible. 10% is not deductible. You would normally be fine. Now that you like next month come and it's bonus season and you got a bonus check for 20,000 from your company and you wanted to from your employer, and you wanted to pay off the personal use portion of your line of credit. So you think you are under the impression that, hey, I will take my $20,000 bonus check, dump it into my line of credit, and I clear out my personal use portion of the line of credit. Then going forward, I would be able to deduct 100% of my interest expense, because the other $180,000 is still used for tax for investment purpose. But the reality is that as soon as you mix in the personal use with the business use, even the repayment that you are dumping in, the bonus check that you got from your employer, that you dump into the line of credit for repayment, that $20,000, 90% of that $20,000 will be used to repay the business loan, and then the 10% of that would be repaying the personal use loan. So essentially, as soon as you mix the use between personal use and business use, any repayment that you make will always be prorated, and therefore all the interest expenses will always be prorated accordingly. So this is why it's important to, if possible, to have at least separate line of credit. When you do, if you have two line of credit, one is for 180, the other one is for 20. When you dump the $20,000 directly to the second line of credit for personal use, you then would be able to eliminate that proration effect down the road. Mortgage interest versus mortgage principal. This is very interesting. A lot of real estate investors talk about cash flow. More often than not, they don't understand that if they have a cash flow neutral property, meaning that you're not the rent is enough to cover all the expenses, including mortgage interest and mortgage principal, it doesn't mean that they don't have any taxable income. They might still need to pay tax. The reason is because in Canada, most of our residential mortgage, or almost all the residential mortgages that I've come across, they are all blended payment. What it means is that a portion of your mortgage payment is paying the mortgage interest. The other portion of the mortgage payment is paying the mortgage principal. Now, but mortgage principal is not tax deductible expenses, it's paying down your debt. But mortgage interest is tax deductible. So even if you have a cash flow neutral property, you may still have tax payable on your income. So just be prepared for that. Don't be surprised to have a tax payable when we come to calculate your taxes. Now, property taxes and utilities, as I mentioned before, the general rule for tax deduction is that any expenses that you incur for the purpose of earning the particular income would be tax deductible, subject to a bunch of exceptions. Property taxes and utilities are earned for the purpose, including insurance, are all earned for the purpose of earning the income, rental income, and they are tax deductible. Now, are accounting fees, bookkeeping fees deductible? Well, accounting fees to do your personal tax returns are not tax deductible, but accounting fees to do your statement of real estate rentals would be tax deductible. So be mindful of that. The bookkeeping fees the bookkeeping fees or the bookkeeping cost to do your books for your rental properties are tax deductible. The bookkeeping fees cost to calculate your stock trading investment portfolio, they are all tax deductible. But again, the tax fee, the cost to do your tax return on its own is not tax deductible. Now, property management fees are tax deductible. We mentioned that earlier. One thing that is worthwhile mentioning is that if you pay your real estate agents or your property management company a full amount, a full month rent to fill your unit, the full amount would be tax deductible as well, all at this year that you incur the expense. Repairs and maintenance. Repairs and maintenance is a huge topic. Repairs and maintenance is also a gray area. The reason why I say this is because there are expenses that you may consider repairs and maintenance, but the reality is that in CRA's eyes, they would consider it as improvement to the property. If you're doing improvement to the property, they are considered part of your building, and they are considered capital asset. And as soon as I mention the term capital asset, that means you cannot deduct it immediately. You will have to add it to the cost of the building. And when you add it to the cost of the building, it means that you can claim something called capital cost allowance against the building, but you cannot claim it as a one-time write-off. And as soon as I mention the word capital, if it's an improvement is on the capital account, the concept income versus capital comes back. When it is capital, let's say you buy a property for $500,000 and you spend $100,000 on improvement to renovate the basement, convert it to a second unit, 2-unit property. Now the cost of the building is $600,000 instead of $500,000 that you purchased. Now you add $100,000 renovation cost. Now the cost of the building is $600,000. When you sell it 10 years down the road to another person for $1 million, that $600,000 is used to offset against the sale price. So you pay tax on the $400,000. But as I mentioned before, because it's on capital account, so what it means is that the gain, the $400,000 is only 50% taxable. And so what it means is that anything that's considered an improvement to the property being added to the cost of the building is also 50% deductible. I know it gets complicated, but basically everyone wants the expense to be called repairs and maintenance, because repairs and maintenance is 100% deductible, and it's also being deducted against your rental income. And if you have a rental loss, the loss will be offset against your other income. If you file your tax return, personal tax return, then this rental loss could potentially offset against your employment income. If you pay full tax on your employment income and you end up having a rental loss, you might be able to get a refund. Now, the key here is how do you determine whether something is considered repairs and maintenance? Because at the end of the day, you can call any expense that you incur on the house, as small as painting the wall, as an improvement, right? Because it's really improving the look of it, or replacing the carpet. It's also improving the look of it. So how do you decide whether something is whether something is improvement or not? Well, the reality is that there are a few exceptions, which we could go through really briefly and quickly. If you buy an old home and you buy an older home, I invest in Hamilton, so let's use my home as an example. One of my rental properties, if you buy a post-war bungalow on the Hamilton Mountain, for say right now it's crazy, but when I bought it, it could be as low as $250,000 when my daughter was born, and now of course it may be like $600,000-$700,000. Anyway, that $250,000 rental property that we bought, if you take that $250,000 property and you buy it, and you know that you are going to spend $100,000 going in to convert the legal base, the basement into a legal secondary suite, the $100,000 that you incur for getting the house ready for rent is not deductible as repairs and maintenance. They are considered improvement. You have to add that to the cost of the building. For example, another example, let's say you buy this old property, again, using my $250,000 Hamilton property that I bought in 2014. If you buy that property and you have to, just paint, it's very common for our client to paint it, paint the wall or replace the carpet. These expenses, normally they're considered repair and maintenance in the eyes of CLA. So replacing the carpet, painting the wall, replacing the light bulb, in installing the smoke alarm, those expenses normally are considered repairs and maintenance. But if you buy an old home and incur those expenses to freshen the house up, just so that it could be getting ready to rent, that expenses during that period that expenses that you incur would be considered capital expense, because it happened immediately after you purchase and you incur it for the purpose to get it ready for rent, get the house ready for rent. So that's one exception. The other exception is that if you incur any expenses at the end and you try to freshen up the house again to get it ready for sale, that expenses would also be considered capital in nature, and therefore you cannot deduct it. It has to be added to the cost of the building and offset against the sale proceed. So not as beneficial. Those are the two biggest exceptions. Now, other than that, if you simply replace your carpet with carpet, that is considered repairs. You paint the wall, that's also considered repairs. If you replace roof with roof, and you replace the roof with the basic quality of roof, similar and consistent with the previous roof, I would also deduct it as an expense, provided that is not incurred immediately after you close the property to get it ready for rent. So timing matters, and how you spend the money matters as well. And then at the end of the day, as an accounting firm, we also look at how likely you are going to be audited. There are times that I know that my clients would be at high risk, and we fight with our client. There was a really aggressive client who is also a realtor. He was fighting with me on deducting $50,000 of expenses and thinking that he could get away by incurring $20,000, $30,000 of losses. And he's been incurring $20,000, $30,000 of rental losses for a number of years. So it really goes back to your particular situation. The moment that you get a refund from CLA, you might think that it is a good news, but it's also a trigger for CLA to audit you, because the moment that you ask them for money back, chances are they want to dig a little bit deeper. So that's something to keep in mind. Now, what is capital cost allowance? The next thing on the list is capital cost allowance. Capital cost allowance is also called a depreciation in the accounting term, and it's also called a wear and tear on the property, on the capital property of your rental portfolio. Now, capital cost allowance, typically for if you buy a building, buy a house, and building is CLA allows you to claim 4% of the building cost as a deduction against your rental income, but you cannot deduct. You can only deduct it up to the amount of net rental income that you are reporting. You cannot use capital cost allowance to create a loss. Now, but the other thing about capital cost allowance is that capital cost allowance is very similar to RSP. So for those of you who are not familiar, RSP, when you deduct the RSP, you don't pay tax on the amount of RSP contribution that you make. But then the moment that you take out the money from your RSP plan, you have to report RSP into your income, and then you pay tax in accordance to it, to your marginal tax rate. In the case of capital cost allowance, the year that you claim the capital cost allowance to offset against the net rental income that you would otherwise have to pay tax on, you don't pay tax that year. but the year that you sell the property, that you claim capital cost allowance of, you will have to take all the capital cost allowance that you've claimed over the years and claim it back as your rental income. And a lot of people get confused because they sometimes think that the capital cost allowance would be taxed as capital gain because you only get taxed at the end when you sell the property. The reality is capital cost allowance was deducted to offset against rental income. So when you sell the property, you still take it back into income, 100% taxable. Now, this is a tax deferral mechanism. Is it worth it? For a lot of high income earners, I think it's worth it, especially in today's high inflationary economic environment, because our government is printing money like crazy. And so claiming capital cost allowance seems like the way to go, but you just have to keep in mind that at the end when you sell the property, you have a larger tax bill coming up. Auto mileage is tax deductible. If you drive around to manage your property, you would then be able to deduct the auto mileage. And typically there's a lot of receipts that you have to keep, because you can deduct gas, you can deduct insurance, you can deduct maintenance and repairs, you can even deduct the lease, or if you own the car, you can deduct the wear and tear on the car as well. You can probably deduct CAA. You can also deduct 407 bill if you also incur it as part of your automobile expense. The key here is that you have to keep a logbook, and only the mileage that's incurred related to the purpose of managing your portfolio would be tax deductible. The way it works is, let's say during the year you incur 1,000 kilometers for the purpose of running your rental portfolio, and for the entire year, you've driven the car for 20,000 kilometers. And so 5% of all your expenses would be tax deductible. So 5% of the gas bill, total gas bill, 5% of your car insurance, 5% of the CCA on the car, or 5% of the lease payment would be tax deductible. Yes, it's a lot of work to earn not so much tax deduction. So it is up to you whether you want to keep it or not, but that is something that you could totally consider adding. Home office expense. Home office expense is tax deductible against rental income, but you cannot use home office expense to create a loss. You can carry it forward to the year after. Now, home office expense, again, similar to what auto mileage is, it's like you need to have a dedicated space in your home to deduct against your home office. To deduct against your rental income. Home office expense includes deduction of your mortgage interest, your property tax, insurance, utilities, internet, all of these, but only to the proportion that the size of the size of your business, size of your office that's dedicated for the use of running your rental portfolio. So typically for someone who lives in a 2,000 square feet house, and they have like a upstairs bedroom dedicated as their office, let's say it's 100 square feet, 5%, 100 divided by 2,000, I think that's 5%. 200, yes, 5%. So 5% of all the expenses that I mentioned above would be tax deductible. You also need to keep a floor plan as well in case CRA ever audits you. Membership and education. I know a lot of you came here and I don't think there is a membership fees, but a lot of the real estate meetup, as well as big real estate clubs out there, they do charge a real estate, an admission fees as well as a membership fees. I've got clients who pay as much as $20,000 to $30,000 to learn how to get educated, to learn how to invest in real estate. And these fees may or may not be deductible, really depending on what you do with the knowledge that you learn. I've got clients who attended a US conference that teaches them how to flip properties, and and they incur $30,000 and they were trying to deduct it against their existing rental portfolio. The reality is that if they ever got caught and CRA asked them why you are deducting that $30,000 that you incurred, it doesn't fly because you did not incur, remember the general rule that I mentioned earlier, you did not incur that $30,000 course that teach you how to flip properties to earn your rental income. So it doesn't even have a direct link. The key is to be able to have the direct link. Another example I can give you is that you incur the education expenses and you don't take action. You sleep on it, you may have to do a ton of research before you take action, and you might not take action at all. And if you don't take action at all, there is no income to deduct against. So it's not, education is great, action is much more important when it comes down to the deduction. And so this is something that you should talk to your accountant. If the amount is to, for example, if you do pay an admission fee or some membership fee, small amount of membership fee to get real estate knowledge to run your rental portfolio, I would totally deduct it. Sometimes the auditor do not see the direct link between incurring the expense and running your portfolio. And we can argue all day long. And sometimes it's just easier to pay for the tax than arguing with the auditor. But so far, I have not seen anyone saying that, oh, that's an issue. It's more for people who incur like tens of thousands of dollars on education. That would be an issue. Now it's 8:43. That what it means is that I only have 17 minutes to cover incorporation. So hopefully I can cover everything about incorporation quickly as possible. Okay. Now, what are the benefits of setting up a corporation? Essentially, there is some tax benefit that can be achieved. There could be tax deferral by using CRA's money to buy properties for yourself. For those of you who don't know, I mentioned earlier, if you are flipping, you're doing wholesaling. I have a bunch of clients who do wholesaling. They are earning those income as active business income. And active business income is only taxed at 12.2%. Whereas if you earn those flipping income in your personal name, you could pay as much as 53.5%. So the delta could be as much, the tax deferral could be as much as 40%. If you house those flips in a corporation, you could pay you could save as much as 40% tax. And if you save 40%, that 40% by leaving the money in the corporation. If you take the money out, then that's a different story. If you put it and leave it in the corporation, you have an extra 40% to invest for yourself and dump it into the next project. You're essentially using that 40% tax deferral money, CRA's money that you would otherwise pay to CRA, to invest for yourself. So it's a lot more tax efficient if you have a small business, if you're a small business owner, or if you're doing flips wholesaling, to own the properties inside a corporation. Now, have control over what the banks see on your personal credit report? This is something that I call a mortgage virgin. If you are following my blog, sometimes I talk about mortgage virgin. What it means is that what we found over the last little while is that if you qualify for the mortgages directly inside the corporation's name, the bank may or may not register the lien against your personal credit report, even though they almost always require you personally guaranteeing the loan. Now, how do you take advantage of that? I'll tell you a true story. I own a few properties and someone was asking about trust agreement and a corporation. So I own a few investment properties in Hamilton and I bought them all in my personal name. But because I also am a small business owner, I want to use CRA's money to buy properties for myself. So I want to own all these properties inside the corporation. And so the way that I did it is that I qualify for the mortgages in my personal name and I bought it in trust for the corporation. So I get to report all the income and expenses in the corporation, assets and liabilities as well. Everything was run through the corporation except the mortgage qualification part. And all these mortgage mortgage is registered, all these 3 mortgages were registered in my personal name, and it appeared every time I tried to qualify for financing. For those of you who are on my blog, and you would have known that I am moving. We just closed on our new home last week, and I was trying very hard to qualify for financing. But because the bank saw all these number of properties, all these numbers of mortgages on my personal credit report, they are saying that, well, we can't give you a mortgage because you have these many properties in your credit on your credit report, even though I have these properties are all cash flowing properties. They have more than enough to cover the liability. And so what I did was I discovered this problem a while back before I started looking for my property. I knew that I had to move these properties into the corporation directly. So I moved them to I tried to work with a bank that would be willing to work with the corporation directly. And I moved them all to the bank, to the corporation, and I changed the mortgage company. I also changed the title. Actually, Hussein was the one who changed the title for, Hussein helped me change the title. So I put all these properties inside a corporation, and my first bank that I qualify in my personal name with, that first bank removed their lien against my personal credit. And the second bank that qualified me under the corporation did not register a lien against my personal credit. And this helps with my mortgage qualification for my primary residence, for my new primary residence, believe it or not. It is a little bit crazy how this whole thing works. You may think that, oh, well, like you are lying to the bank. I am not lying to the bank. I told the bank everything. Actually, the bank that I work with is called is Meridian. Meridian is the bank that gave me the mortgages in the corporation. And I work with the residential side for my primary home. And residential side, the primary home side underwriter was saying that because all these 3 properties are inside the corporation, they did the financing, right? So they don't count those properties as part of my ownership when I qualify for my own primary residence purchase, which is kind of interesting to see because they know everything. They have all my financial statements, my tax returns and credit reports. So that's something that if you are interested in, if you think that you want to grow your portfolios to many, many different properties, corporation can help you to control what shows up on your personal credit report. And it might be helpful for you to grow, take it to the next level, take your portfolio investment to the next level. Income splitting with lower income family members. Again, like I mentioned before, there is that refundable dividend tax system with the rental income. So you pay 50%, 30% would be refundable when you declare a taxable dividend. If you structure it right, there would not be any attribution rule. And if you structure it right, your low income family members could be the one that's receiving the dividend, and it will help you pay lower income taxes. Lower your overall income tax from your entire family. And of course, if you structure it right, you can also save and grow your portfolio faster. Like I mentioned before, if you use, if you do a lot of flips, and having that corporation would help you to pay a lot less tax. And at the end, there is also liability protection. I know you buy a lot of, people say that, oh, I buy insurance, but insurance company is also in the business to protect themselves. A lot of you don't understand that the moment that you file your claim, that they are going through the list of this claim, all the fine prints to see what you haven't done, so then they can get out of the claim. So that's something that you have to keep in mind of. Now, the disadvantage of having the corporation is that only certain lenders work with corporations. A lot of mortgage brokers out there do not work with corporations, which make getting financing a little bit more troublesome with corporations. So you might have to work with the bank directly, or you are only restricted to work with certain mortgage brokers, because only a smaller number of mortgage brokers would be willing to work with corporations. And then you miss out on certain financing options. Sometimes the bank charge a little bit more interest, but because I'm trying to grow my portfolio, I am willing to pay a little bit more interest expense. And even with the Meridian bank that I work with, the interest expense that I got was 2.54%. I know it's not 1.54, but I'm getting 2.54 on a rental property. I am not complaining at all. Setup cost is there. You have to pay $2,500 to set it up. We set it up for $2,500. There's annual tax return filing as well, $2,400 per corporation. Limited liability does not cover gross negligence. If you are trying to be a slumlord, that's not going to work as well. If you do a 3-tier corporation, which is very common in the amount real estate investors, there's a potential impact on the management fees that's over $30,000. So here is all the disadvantage of setting up the corporation. Here are the 7 questions that I normally walk my client through to decide whether they should set up a corporation or not. First, what type of investment strategies are you using? If you are buying long-term rental, it may or may not be beneficial. And depending on how many you are buying, the number of properties that you're buying is important as well. Because if you're buying more than one, remember you can control the amount of information you give to the bank. But once it is registered in your personal credit report, you can't have any control because the bank would know no matter who you are. We bought this office condo as well, and it is totally purely based on my business income and expenses, but they still want to do a credit check on my personal name, and they would find out everything that I own. So it's important to have that control, to have that shield from the lender if you have the option, or you may just want to disclose everything. Do you want limited liability against your personal asset? People don't understand that if you get sued by one of your tenants, all your assets, including your personal home, would be subject to it would be exposed to the same risk. Do you really want to expose all these much risk to only one property? Probably not. And that's why sometimes you set up corporation to protect your other asset, not necessarily just to protect your own, like that particular asset. Do you own another small business? I own another small business, and a lot of my clients own another small business. And it helps when you own another small business and you don't need all your cash flow from the small business. You can take advantage of the low tax environment in the corporation, pay as little as 12.2%, and use the high after-tax earnings to finance the purchase of your rental properties. Are you planning to pass your portfolio to future generation? This is also a great question. Like Hussein mentioned earlier when he did the presentation, if you are if you have the corporation and you own your portfolio inside the corporation, you can avoid paying the estate administration tax. If you want to pass on your portfolio to your future generation, more often than not, there is a tax planning involved. There is a tax planning strategy that involves the use of a corporation. It's called estate freeze. You freeze the value of the asset at the time when you decide to sell it, to transfer it to your kids. You try to sell it to your kids on a tax efficient manner. And if you use an estate freeze is more often than not would involve this use of corporation. But if you own everything in your personal name, you would have to then transfer everything into the corporation, which will trigger land transfer tax and cost of transfer by the accountant on a tax deferred basis. So there's a lot of costs associated in the future. And this is the reason why we would set up the corporation early. Now, here are some common structure. I'll go through it as quickly as possible. You can have one corporation, multiple properties. It's the easiest and the cheapest way to set it up. It's suitable for beginner. You can all use the same corporation to own as many properties as you want. Sometimes I would recommend you to have a second corporation. When you reach a certain point, we would remind our clients, hey, are you comfortable? Because if you, again, going back to the same risk segregation that we talked about in the past, if you get sued by one of your tenants, all your equity within the same corporation would be exposed to the same risk. So that would be the reason why you would want to set up multiple corporations. From a tax perspective, there is no difference. Now you can have one corporation, one property. That one corporation owning one property, it may or may not be effective in your situation, but it might be effective in certain situation. For example, the corporation that own my I set up a corporation specifically owning this office condo because we also have a tenant, and we don't want to be exposed to exposing our residential rental portfolio to the same risk as the commercial unit, because there are a lot more people coming in and out of the building. So that's the reason why we set up a second corporation for it. I have client who set up one corporation for their the whole apartment, residential apartment. So those are the reason why you would set up one corporation for one property. If you feel that the particular property is especially risky, that's what I would do. Three-tier corporation is a very common tax structure that some genius accountants set up back in the days, and it's very common among real estate investors. Basically, you create three corporations. The property management company is created just to service the real estate corporation, because property management fee, like I mentioned before, they are considered active business income and they are taxed at 12.2%. So the property management company charged the real estate corporation a management fee under a management contract, and the money that the property management earned would be only subject to 12.2%, whereas the money that's earned in the real estate corporation rental income is taxed at 50%. So there could be some potential tax saving. The only thing is that the property management company, if they charge over $30,000, it's subject to HST, so the saving is not nearly as much, and there's a lot of bookkeeping and money transfer that has to be done on a regular basis to make this whole strategy work. Typically, I don't advise my client to use this strategy. It's really based on what you need and what you want and how much time you have in your hand to implement this strategy. I've also seen it done many times and it wasn't done properly, and the property management company is reporting losses, and when the property management company is reporting losses, it's totally defeating the purpose of setting the whole thing up. Lastly, ultimate investment machine, that's the small business. Instead of property management company, you have a small business that's earning small business income. I have client who owns an incorporated business. He brings in about $200,000 annually from the business, and he paid most of it to himself before he came to me. And then the wife works as an employee, makes about $120,000 at her current job. They are probably, in the eyes of an average Canadian, a power couple. Before tax planning, he paid a lot to himself, so the corporation only has $20,000 left to invest, and he paid $3,000 tax, and then after tax is about $17,000. And he paid a lot to himself, so he paid a lot to personal income tax, and that income after tax is about $117,000. His wife pays taxes because she's an employee. There is nothing we could do. Now, but after tax planning, it's a small tax planning that we are planning. We limit the amount that the husband would take out because he can spend all his wife's money. There is very little we could do to lower his wife's tax payable. So we decided to spend as much as possible the salary of the wife. So we would spend mostly the wife's salary on the daily necessity because she has to pay taxes anyway. So we pay only the husband only $40,000. So that lower his personal income tax to $6,000. And the corporation retained a large amount of profit. Instead of paying it out, we just retain it. And so the at the end of the day, the after-tax cash available is $259. After we do the small switch, before the switch, they would have net $219. There is a $40,000 tax deferral created 1 year. And imagine you do it every single year, because this guy has been in business for the last I don't know, almost 10 years. He's been with me almost 10 years. So this is how he built up his 10 property portfolio using the tax saving that he got from using this strategy. Again, just a recap, 7 questions to determine if you should incorporate. And don't forget, you can also get access to the video recording on how to turn your primary residence mortgage into a tax deductible mortgage. Here's the link, realestatetextips.ca/ONREIA. And here is my, just to recap, follow me on Instagram, Facebook, and I am ready. I am done. I'm ready to answer some questions.
Amazing.
And we have a lot of questions for you.
That was
the question
amazing.
box is full.
Yeah, that was so fantastic. I mean, tons and tons of info, so much value here and so much content. So to all of you who were worried, like, oh my goodness, this is going so fast, this will be posted on our ONREIA YouTube channel. And if you just go onto YouTube, you search the Ontario Real Estate Investors Association, you will find us there. Also, if you joined us on this webinar tonight, I should have your email, and I will every month I send out the replay in the email. So if you don't see it in the next few days, check your junk mail. It might have gone there. Okay. So I'm like, incredible. We've got 27 questions lined up, and I know we had some in the chat as well. So we'll get to as many as we can. How do you feel about questions, Cherry? How long do you want to go here?
Maybe let's do 15 minutes. Let's end at 9:15.
Sounds good.
I'm pretty good at answering questions. I've handled this multiple times, but typically as I answer questions, more questions would come up. And usually at the end of the 15 minutes, I would still have 27 questions.
I believe it. I believe it. Okay, well, let's try and get through what we can here. So Elena asks, Cherry, you mentioned limited partnership. Is the income paid as an individual in this case or as a corporation?
So depending on who owns the limited partnership interest, if the partnership interest is owned by the individual, there's a lot of deal out there that's in the form of limited partnership real estate deal. So you buy an interest in the limited partnership, and if you buy it in your personal name, then your personal tax return would be reporting the income and expenses. If you buy them in your corporation's name, then your corporation will be reporting the income and expenses. If you buy them in your RSP or TFSA account, then no income or expenses need to be reported.
Okay, awesome. Mary's asking, so Mary and her husband have a rental property under their own name. What's the process of changing from personal name to bare trust declaration in a corp? The mortgage is now with an A lender.
So if you already own the property and you don't have a corporation set up and you don't have the intention to always buy it in trust for the corporation, then it is a little bit late. You cannot just simply use a bare trust agreement to own it inside a corporation. You will still incur land transfer tax. You can use the bare trust, but then the bare trust transfer you would only be able to do the transfer at current date, and a land transfer tax would be triggered. So that's the answer. So I generally do not recommend that to do the transfer. It depends on obviously your particular situation. There are some exceptions.
Okay. Gabriel's asking, what is the minimum time for buy and hold capital gains?
There is no fixed amount of time. CRA doesn't really give the time. CRA like it to be gray, so they could go whatever they want. But the reality is that if you buy and sell within the same year, like within 1 year, those are low-hanging fruit for CRA, and they are going after those low-hanging fruit. So if you buy and sell in the same year, be careful. Chances are they're going after you. The other thing is that the number of years is only one consideration. You might not get caught with the first purchase or sale, but at the end of the day, you might get caught by the second sale of your property. So let's say you buy and sell one property in the first year, and then you take the profit and buy another property and immediately sell another property. It might not be the first transaction that triggered the audit. It might be the frequency of the transaction that would deem everything that happened before to be on the income account.
Okay, good point. Marshall's asking regarding capital gain tax on basement apartment in his principal residence. How is that treated when he sells? And if the unit was rented, then occupied by a family member, can he avoid any tax implication?
So these situation is very specific. To qualify, I would always try to claim the basement as my primary residence. And I would try to avoid paying any tax on the legal basement unit. Now, here is the kicker. I use myself as an example. The home that I currently live in, my old home, my existing home, it is a two-floor home, subdivisional home, but it has a walkout basement. I rented the basement for a couple of years, but I bought it. The basement is pre-existing. So because I bought it as pre-existing, it's only 1/3 of the house is being rented, I am able to claim primary residence exemption. I didn't do any structural change to the property. Majority of the house is still being used by me as my primary residence, and I would then continue to qualify to claim the whole house as my primary residence. Now, in the case where it's a bungalow, so 50% is occupied by you, maybe 40% is occupied by the tenant, and 10% is the common area or the utility room. So then that 40% could be considered substantial use by a tenant, and it's not used as for primary residence purpose, and therefore it might trigger capital gain tax on it. The other thing is that CRA also doesn't allow you to continue to claim capital gain primary residence exemption if you do any structural change to the property. So it depends on the extent of renovation that you've done on the property. It might or may not be allow you to claim that as your primary residence. It also goes back to how much a percentage that you've rented out. So these are the factors. And it goes back to your particular situation. Sorry, I don't have a straight answer because Income Tax Act is not straightforward.
No problem. All right, Penny's asking, does CRA accept scanned receipts, or do we have to keep original paper receipts?
Yeah, CRA does accept electronic copy because they are just getting more ahead nowadays, finally.
Yay. Gabriel asks, what about finance charges from CMHC after 5 years?
You could still, if you refinance it again and incur an additional cost with CMHC, you would then still be able to claim that in the next 5 years.
Perfect. I'm trying to find you questions that aren't super specific here so everyone can learn from it. Elena's asking, if I refinance my investment property and take out equity to finance another deal, do I write off the new portion of the interest against the new deal or against the property that was refinanced?
It doesn't matter. Either way, it is tax deductible, but maybe for your tracking purpose, you want to track it against the property that you purchased, because at the end of the day, the interest is incurred for the purpose of buying the second property. So you want to know if that property is really giving you the profit.
Okay. Anna is asking, if you use a HELOC to improve the property, like renovations, is the interest on the HELOC used for the renovation as a tax write-off?
Hi, Anna. You can totally email your client manager to get this question answered. By the way, yes, the answer is yes.
Awesome. Okay, Gigi's asking, what happens when you don't sell the property? So you're holding to generate income. Would you have to pay back capital cost allowance?
Yes. The moment when when you pass away and when your spouse pass away. Typically, when we pass away, our assets are usually being transferred to the spouse or spousal trust, depending on how Hussein draft up the will. But if you do that, it get transferred, and then the second person who died will have to take it as capital gain. The estate would have to, not capital gain, sorry, income.
Income. Okay. Nancy's asking for the home office expense deduction. If you don't have a dedicated office space just for managing rental properties, can you still claim this deduction based on time spent?
Yes, you can. Great question. As a matter of fact, CRA this year, they changed their form. They actually ask you the number of hours that you use for a particular space for business purpose. So yes, you can do that based on the number of hours.
So it could be like from your bathroom.
Yes, absolutely. But as you know, if you count your bathroom, how long can you really work in your bathroom, right? Like 5 hours of the day?
You haven't been in our house, I guess.
I don't want to know.
Right. Andrew is asking, can you deduct specific gas receipts against specific trips to your properties rather than take a percentage of total cost prorated, like track mileage and match it to dedicated gas receipts?
I think it's up for the interpretation of the auditor. I don't see why not. I have a client who drives a company car and the company pays for all the gas, but of course, out of the goodness of his heart, every time he drives to his rental property, he would just pay for the gas himself. He only deduct those gas expense.
Okay, awesome. Let's see here.
Like we have time for one more.
Yeah, let's do one more. And sorry, everyone, if we didn't get to your question. So Charles asks, should we keep the mortgages of the corp of the rental properties with separate lenders to minimize the visibility?
Yeah, so I was told actually someone shared this with me. This lady who co-founded a real estate investment trust owned property, one property in one corporation, just so that they could control the amount of information given to the bank. And they work with maybe corporation number one would be bank number one, corporation number two will be bank number two. So then you kind of can reuse your personal credit for multiple corporations.
That gets expensive though when you're setting up all these corporations.
So you try not to. You try to work with as many properties as possible with one bank. You max it out, then you move on to a second bank. Yeah, it gets expensive, but depending on whether you want to work with a lender or not, right? If you tap out and you have to work with Home Trust, which you pay like 5% interest, it's still expensive that way.
Wow. Well, the comments that we see here in the chat, people are saying this is incredible information. That was the most useful and educational 60 minutes of my life. That was Mario. Amazing presentation. So much information here, and
Thanks,
it can be a little overwhelming. So if you do have more questions and want to keep getting informed, remember Cherry puts out a blog every week and is always posting things to social media. So make sure that you do follow her on Facebook and Instagram, and check out her blog on her website. And is that just the best way to connect with you, is on social?
Yeah, absolutely. Because I do my own event as well. So if you want more of these overwhelming webinar, you can get more of this if you're not tired of it yet, by signing up on realestatetextips.ca. I am taking new clients as well, but you can also connect through to us through the realestatetextips.ca. There's the phone number and then email address on the website as well.
Awesome. Well, everyone, give Cherry a big virtual round of applause. That was fantastic. Tons of value shared tonight. And like I said, you will be able to watch the replay of this on our YouTube channel. Just go to YouTube, search up the Ontario Real Estate Investors Association, and you will see it come up. So thank you everyone for sticking with us. We still have over 100 people with us here. And we won't take up too much more of your time. I just want to mention a couple more things before we wrap up for the evening. Of course, make sure you are following us on Facebook and Instagram as well, and like and subscribe to our YouTube channel. We have a goal to get 1,000 subscribers before, well, as soon as possible, really. So we have 2,500, I think, followers on Instagram and another 2,500 on Facebook. So if we can get everyone, or just do one subscribe, that'd be lovely. And then we can share out some more great stuff. Also, wanting to let you guys know about next month's event. So we're super excited. Unfortunately, well, not unfortunately, we won't be in Costa Rica for this next one, so you won't get the nice view that we showed you at the beginning. But mark your calendar for, I should have had this open, mid-April. We have Pierre-Paul Turgeon coming. And for those of you who are not familiar, he is an expert when it comes to multifamily investing. Now, he is going to be talking about multifamily investing secrets, how to source, and how to finance apartment buildings in Canada. This is going to be a super deep dive, and he is going to be our only speaker next month because there is going to be a lot of content to share. So whether or not you're brand new or you are an advanced investor, you're going to want to make sure you attend. So that is April, I should have had my calendar open, April the 14th. That is a Wednesday. So make sure you put that in your calendar. I will be sending email updates. Also, one more thing is now that we have all this space on our webinar, we can have more people, it is a little more costly, and we're going to be looking for sponsors. So if you or someone you know are interested in supporting this, keeping this as a free resource for people, this is our way of giving back and helping people learn more about real estate investing. And we want to try and keep it free if we can. So if you are interested, if you have a business and would like to promote it, of course, promote it, be one of our sponsors, then make sure you DM me and we can have a little chat. So thank you once again to all of our speakers tonight, and thank you to Corey McKinnon for running the background for us on the technical stuff. Thank you for all your questions and your engagement. Yes. Remember, take action. This is something that, book an appointment with your accountant, or if you don't have someone, reach out to Cherry. Make sure you think about your estate planning. And if you don't have someone, reach out to Hussein. This is what we need to do, is keep moving forward in our real estate business so we can reach those goals. So Shawn, have you said anything tonight? I think I cut you off all night long.
That's okay. I'm just the eye candy. You just keep talking.
Okay. That's all we have for you guys tonight. Thank you again for being so active in the chat and being involved. And everyone is saying thank you. Awesome. All right. I'm so glad everyone got lots of value out of this evening. Take care. We will see you guys next month. I'll be posting the registration links shortly, and enjoy the rest of your night.
Thanks, everybody.